back. You're watching The Money Show on ET. Now, we were just talking about share trading, specifically because a lot of you have got into this habit of sort of trading in shares, especially during the lockdown, where I'm sure many of you guys have really been bored with offices and your workplaces being shut. But is share trading the right way to go about, especially when you have a separate job, something that does not involve stock markets? You have your own business to look after, and your goals largely are long term. You may not really have the time to sort of keep a check on the markets and the nitty-gritties of equity markets. So who is share trading for? Who is long-term investing for? Let's bring on board Samir Kaul, the MD and CEO of TrustPlutus Wealth Managers India. Samir, it's a pleasure having you with us. Many thanks for taking out time for us on The Money Show. You know, we had the AMFI data that was released today a couple of hours ago, and it indicated that it's the fourth straight month that investors have redeemed more mutual funds that they invested. So basically there are outflows. People seem to be removing money more than they are investing in mutual funds. And then on the other hand, you have this share trading activity, which my colleague Kunal as well was highlighting, that, you know, in the cash segment activity increased by 50 to 60%. So if you have to say that, oh, people redeemed money in mutual funds because, you know, they needed it during this entire cash crunch that the lockdown threw upon, we're seeing more in share trading activity. Why do you think this phenomena is being witnessed?
Well, I think if I heard you speak a bit earlier, you were talking about the fact that a lot of people are temporarily sitting at home, and you know, getting started with trading stocks is not a very difficult activity. So I think once people open a brokerage account, people are dabbling in stocks. But I think we've seen this trend several times over, where people think that trading in stocks is a fairly simple activity. Well, actually, it's quite complicated, and only people who have got relevant experience should basically undertake you know, trading in shares. Right? Can you hear me?
Yes, all right. Okay, yes, we can hear you, Samir. So yes, there has to be some sort of experience that, you know, individuals should have. You know, the young have definitely seemed to have chosen their investment course and investment tool during the lockdown. Like I mentioned, heightened share trading activity. What would you advise them? I mean, I'm sure that's not your recommended tool, you know, to kickstart your personal finance journey.
Well, I think our advice to anyone, unless he or she is a full-time professional into capital markets, is to basically use the help of advisors, because the advisors should be able to do proper diligence and then do proper research before making recommendations. So we don't advise people to dabble in shares as a speculative investment, because history has taught us that anything that you do from a speculation or speculative perspective ends up, you know, in a not very good way for the investor, and people end up losing money. Because what we've seen is each time there is some kind of a bull run, you have people acting on tips. You have people who are trying to buy stocks whose name they cannot pronounce. You have people buying companies without understanding what the companies do. And even if there is a short-term spurt in the price of these stocks, people think they've become like a star fund manager and they can manage their own money. So our advice is very straightforward. If you are running, like you said a bit earlier, your own business, or you have a day job, please trust your personal finances to an advisor whose job is to basically manage your money. You can always create a small portfolio to keep yourself updated with the market and with what's happening with a few companies. But don't try and do everything yourself, because it may end up in heartburn.
So for long-term investors especially, many of them also say that, okay, I'm going to buy my own basket of stocks. You know, I'm going to pick blue chip stocks like HDFC or TCS or RIL or whatever. I'm going to pick only blue chip stocks. I'll pick it myself, and then I will keep it, you know, like a coffee can portfolio, as people call. That or mutual funds? I'm talking specifically for long-term investors.
like again, I said it's not just a question of buying Hindustan Lever. The question is how much should be Hindustan Lever in your portfolio? What is the allocation of Hindustan Lever? What is the allocation of FMCG in your portfolio? What is the allocation of financials in your portfolio? If you have 5 tech companies between TCS, Infosys, HCL, and Tech Mahindra, for example, which of the 2 or 3 you should have in the portfolio? All of this requires a fair amount of diligence and a fair amount of research, which is the reason that people have gravitated in the last 25 years towards mutual funds. I'm not dissuading people from creating a direct equity portfolio. I think people who have just outright bought these shares whose names you've taken actually have not done too badly. But again, for the average investor, it makes sense to use a professional legal vehicle like a mutual fund to create a long-term portfolio. By the way, as far as debt is concerned, the mutual fund offers a better tax vehicle in terms of making the investment. Also, people are not, it's easy to buy Hindustan Lever or Infosys or Reliance because you're familiar with the name. But the moment you go lower down the stack in terms of market cap, it is not easy for everyone to buy stocks. It's not easy to gauge liquidity of the stock. It's not easy to do research on the stock. So I feel that if you look at the mid-cap segment, you look at the small-cap segment on equities, people should necessarily use the mutual fund vehicle because professionals are behind the vehicle. They've done their research. Maybe you want to buy some of these, like you call them, coffee can stocks and keep them in your portfolio. Nothing wrong with that. But the diversified portfolio should have some allocation to mutual funds, especially in mid and small cap market caps, and also specifically on debt.
So how much, according to you, Samir, I mean, I'm sure you have certain limits beyond which, of a person's portfolio or a person's income, beyond which, you should not get too adventurous or too risky. Let's assume that somebody has just about moderate risk, taking ability. How much of their portfolio then they are free to, sort of dabble in individual shares?
You see, typically somebody who has a moderate portfolio probably will have an equity allocation of 30-35%. And I would say that, again, depending on how much time you have, you see, there is no one size fits all. I mean, if you are able to spend time, then you should look at trying to create your own portfolio. I would encourage people to think like that. But most of us who have day jobs, who are spending time working 5-6 days a week, don't have that time to be able to spend this time doing this research and understanding a company and then following the quarterly earnings and following the management commentary and reading the annual report and what have you. So I would still say that a disproportionate percentage of such people's investments should go into legal vehicles like a mutual fund, or it should be driven through advisors who can manage the portfolios on behalf of these investors. And a small percentage can be used to create your own portfolio for the sake of your own, developing your own knowledge and your own tracking. But unless somebody is able to allocate time and energy to doing this reasonably for a long period of time, we are not advocating that you should be very adventurous, because like I said, you may end up making tough calls or tough decisions which can haunt you in the long run. So leave it to the professionals, and that's the way it's done globally. I unfortunately cannot give you a one size fit all answer saying, okay, 10% should be in direct stocks, 90% should be in mutual funds. It depends person to person, but only those people should venture in the direction of direct stocks who have the experience, who have the knowledge, who have the time to be able to research. Otherwise, please use professionals for your portfolio management.
Samir, thanks so much for joining us today and giving those important words of advice for all viewers who are tempted to really dive into the world of share trading. Do so, but at your own risk, and just remember that if you're a long-term investor, it's good to trust a financial advisor with mutual funds, etc. And Yeah, it really depends on your risk-taking ability as well. On that note, we'll take a very short break. Don't go anywhere.